Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. Carnival reported earnings on Monday, and I did a video in the last couple of weeks that was pretty negative on the company because I thought the company's debt was just going to be a massive, massive problem. Well, that debt is actually starting to come down a little bit. They paid off about $1 billion worth of debt, but there's a caveat to that. So that's what I want to get into today. My name is Travis William. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And check out my newsletter, Asymmetric Investing, in the show notes. I got a link there. I want to go straight to the earnings report. This is the report and some of the high-level numbers. Net loss was $407 million, but there was positive EBITDA, adjusted EBITDA for the quarter of $681 million. Revenue was $4.9 billion, and the big number that really jumped out was that customer deposits hit $7.2 billion, up about $2 billion from a year ago. I'm going to come back to that. But that was really something that was very notable because this is deposits. This is money that people are giving to Carnival to take future cruises. Management also highlighted here the repayment of $1 billion of near-term variable interest rate debt. So this debt is starting to be really high cost as interest rates rise. That's why management wants to pay this off as quickly as they can, able to pay off about $1 billion in the quarter. Here's a look at guidance. The numbers are a little bit small, but I'll read them out here. For the full year, adjusted EBITDA guidance is $4.1 billion to $4.25 billion. Adjusted net income or loss is expected to be $250 million to $100 million, and earnings per share of -20 to -8 cents. So again, those are adjusted numbers, pulling out one-time items, but they're still expecting to lose about $100 to $250 million for the year on an adjusted basis. Here's the quarterly numbers on the left. This is the 3 months ended May 31st, 2023. You can see that operating income was $120 million. What's the problem with that? Well, the problem is interest expense was $542 million. So when you have a lot of debt, it means you have to pay a lot of interest. Right now, the run rate just of interest costs is over $2 billion per year. That is why paying down debt is going to be really important. This is the balance sheet. I'm going to start with liabilities. There are two big liabilities here. Long-term debt, $31.9 billion. That's about the same as it was at the end of November, the end of the last fiscal year. The big thing that has changed is the reduction in short-term borrowings and the current portion of long-term debt. So this could be a bond that is 7 years in duration, but it becomes the current portion of long-term debt when there's less than a year until maturity. So you can see that the short-term borrowings were reduced by $200 million. The current portion of long-term borrowings were reduced by about $600 million. That sounds great, right? But let's go back up to assets. And this is the thing that jumped out to me. Cash only went up about $400 million, but customer deposits actually increased $2 billion. So a $2 billion increase in customer deposits did not result in a $2 billion increase in cash because that cash was used to pay down debt. That is really what's going on here. Carnival's operations are losing money, but they're booking a lot of future bookings and generating cash through deposits from those future bookings. Some of that cash is being used to fund those ongoing losses, and some of it's being used to pay down debt. That is not a sustainable structure, and it's not really a sign of strength for the company. It's great that there's more bookings. That's really positive. But if you're using that cash flow that needs to be paid for in the future, those expenses associated with that cash flow need to be paid for in the future, using it to pay down debt, that's not a well you're going to be able to tap a lot going forward. So I just want to caution investors with some of these numbers. There's a reason that the stock was down about 10% on Monday. And I think this is one of the reasons that bookings are great, but there's very little ability to actually pay down debt right now. And that's going to be the biggest problem for Carnival in the future, is that this debt load is just going to be a lot to get over. And even with a massive backlog, it doesn't seem like the company's going to make a big dent in that. But what do you think? Love to hear your comments in the comment section below. Don't forget to follow Asymmetric Investing. Thanks for watching, everybody. See you here next time.